When I looked at these earnings, it seemed to be an extension of what we've seen already, but it exaggerated. That is to say, a real pressure on new vehicles, while used vehicles are really the future.
David, good morning. How are you? Yes, it's a pleasure to join you. So at $1.24, that's a 24% improvement in EPS, and we're very grateful for tax reform, that for American retailers, it finally gave us a fair tax rate, and I think it'll be very healthy for the economy in the long run. And yes, to your point, but we talked about it years ago, that rising rates would create an affordability issue for the American consumer around new vehicles, and hence we embarked on our brand extension strategy, which a big part of that was pre-owned, because as affordability becomes an issue, consumers look for affordable alternatives, and one of the ways to address that is get to a different price point. And we have these nearly new vehicles now that are all coming off lease that the consumers find very attractive.
Yeah, so I want to pick up on that because, as I said, you disappointed to the expectations on the new vehicles, but on the pre-owned, actually, you surprised to the upside. And you also have, of course, the service part of your business that you've also emphasized. Is that indicating, frankly, just the rates question? Is that really interest rates that's driving that?
Well, as far as the shift or cannibalization, whatever word you want to use, from new to pre-owned, that is absolutely an affordability issue. With the shift towards trucks, which are at higher price points as far as consumer preference, and you combine that with higher rates, I'll give you an interesting insight. So, of course, rates in a historical context are very low. And if rates had been 10% for the last year and we're moving down to what they are today, consumers would be all excited. So it's the movement that consumers have to adjust to, and quite frankly, they are used to free money for almost the last decade. So this is a bit of a affordability adjustment for them in relative terms. That's the insight. Now, as far as our brand extension into our customer care business, that's clearly working. We're outperforming our growth in gross profit, double our peers, and that's a combination of taking the brand we've built over the last 3-4 years with our expertise and our scale to again get to a new price point for consumers, which they were not offered before, which they are embracing, and is leading to exceptional growth for us.
So going from the specific AutoNation to the broader auto sector, how does that read through to the auto sector? We're going to get GM earnings tomorrow, for example. We have Fiat Chrysler sometime today. Is it going to read through? I saw the most recent estimate from S&P, I think, was something like 16.5 million vehicles next year. So,
in principle, the manufacturers are in a very good position because of the shift to the consumer preference for light trucks, which are, as I already said, are a higher price point and a higher profit point for manufacturers and suppliers. So the manufacturers are in a very healthy position. Now, in a relative term, I expect retail demand on new vehicles, again, to continue to moderate next year. They'll still be at a very good level. Commercial demand remains strong. So I think that I'm not ready to predict the exact number for next year. It'll still be in the high 16s. But at retail, it'll be less than it was this year.
We actually are just getting Fiat Chrysler numbers out right now. They're expressed in euros, and they basically had a slight beat on net revenue, 28.8 as opposed to 27.2, and also a slight beat on earnings per share. So that sort of confirms what you're saying, Mike, as I understand it, that the auto manufacturers are doing all right. But give me an understanding here about if you're moving the trucks, they're more expensive, but the rates are higher. Don't those fight with one another? Aren't they exacerbating the rate problem?
Yeah, I fully agree. And that's where, when you combine that into a monthly payment, it's significantly higher than the last time the consumer was in the marketplace 4 or 5 years ago. And that creates a monthly payment sticker shock. And then they turn to us and say, well, I need to get something at this monthly payment. What can I get? And then you start talking about nearly new and other alternatives. And so there is this shift to more affordable options is underway. We as a retailer can be on both sides of that equation, so we will manage it. Manufacturers, though, On an overall volume, I think it has, at retail, has implications for next year. But as I said, their profitability will be excellent with the shift to trucks.